On to this story now. Growthpoint Properties has announced an increase in its annual dividend payment to shareholders, but the property management group warns of a 10 to 15% decline in distributable income per share next year, as well as an increase in group vacancies to 9.4%. The Real Estate Investment Trust comprises of 535 retail, office and development properties in South Africa, the UK, Australia, Poland and Romania. Growthpoint's loan-to-value ratio, a crucial indicator of the company's financial stability, also increased by 2.2 percentage points. A measure of cash generated per share, called funds from operations, decreased by 4.4%. The business, in the meantime, sold 29 properties worth 1.5 billion rand during the previous year. I'm joined now by the director at Growthpoint Properties, Estienne, and he joins us now. Some good news, Estienne, when you look at the rebound in tourism having been good for Growthpoint Properties, particularly when you look at the V&A waterfront, which contributed positively to the company's financials in this period.
Yes, Xolani, we absolutely, the V&A certainly excelled, and the tourism came back very strongly. That asset literally halved its profit during COVID, but we've seen a marked improvement with the amount of flights back to Cape Town, and the V&A today is full and well lit, and there's very, very strong demand from tenants, and we're also seeing very, very good tourism numbers coming through, which has delivered very strong results in terms of increases in revenue from hotels and restaurants and all other related to turnover tourism, turnover rental.
Estienne, let's talk about something that is something we've seen over the past couple of years, particularly in the real estate investment trusts such as yourself. A number of properties, be it retail, office parks, they are on sale, and during the period under review, you also let go of 29 properties. What's happening to the particular sector right now, as we are seeing a lot of companies such as yourself letting go of similar properties?
Yeah, look, in Growthpoint's case, it's obviously just part of our sort of normal asset management activity. So, I mean, we've got a very, very large business. We've got over 70 billion rands worth of real estate just in South Africa, excluding the V&A. And, in the ordinary course, we're buying new or developing new properties, and then we're selling older, let's call it non-strategic assets. But just broadly speaking, in the sector, clearly, if companies have their share prices at half their stated NAV and the debt levels are moving towards the higher end of what's acceptable, the only way they can fund their activities, and this they have to do to maintain really their business in real estate. You have to continue to invest in the properties. The only way to do so is to actually sell some properties into the market to generate that capital and then utilize it in your business. So I think that's practically probably what is happening. In our case, we're churning capital. We continue to invest aggressively. We've invested over 1.9 billion over the period, 900 in capex expenditure, so fixing up our properties, improving them, and then obviously additional investment of over 1 billion rand in new developments, including industrial, improving our shopping centres, and also fixing up some of our office buildings.
Estienne, I'm sure shareholders are quite happy today because of the dividend that has been declared, but there is a concern, and it's a good thing that you've told them that next year you expect distributable income to actually decrease by up to 15%. What are you seeing? Is it more of a case of load shedding, the macroeconomic environment? What makes you say that the income is not going to be so grand in the year 2024?
Xolani, in fact, it's a more global thing, to be honest, this time around, and it obviously impacts South Africa materially as well, and that really speaks to the increasing interest rate environment. So what we have seen in South Africa from the start of interest rate increases, we've seen a 4.5% increase in interest. Now, that impacts obviously the debt that we haven't fixed in terms of fixed interest rates. So that's around about 23% of our debt. And ultimately, this year, we experienced additional 200-odd million rands worth of additional interest that we had to pay. And next year, with those higher interest rates being in for a full year, they're having a particularly negative impact on our income statement. And it's not something we can pass through to our tenants. So this kind of scenario is also playing out in Australia, in Eastern Europe, and ultimately will play out in the UK, where we have investments. So it's not unique to South Africa. And in fact, across the planet, most of the real estate companies are finding that their income statement for next year is shrinking a little bit. But hopefully, the fundamentals in the market, we'll hopefully see a bit of improvement in the letting environment, certainly in office, and that may help to compensate a little bit of that pain that we're going to be suffering next year.
Estienne, a good set of results for the reporting period, but as you said, some challenges for the year ahead when it comes to interest rates, as you have said, particularly for the real estate investment trusts, not only here but abroad as well. Thank you very much for your time.